2025, where investing often feels like setting your hard-earned money ablaze in wildly inventive ways. Imagine shelling out $450,000 just to be Snoop Dogg's virtual neighbor in the metaverse, or dropping $7 million on a simple JPEG that might lose value overnight. And don't forget YOLOing your life savings into Dogecoin, making and losing $2 million in under a year. The ways to watch your wealth vanish seem truly endless these days. But today I have something truly special to share with you, my friend. It's a trade that's like texting your ex at 2 a.m. You know it's a terrible idea, yet everyone's still doing it. And the best part? This blunder is unfolding in real time as you watch this video. Picture yourself as an everyday investor, feeling the FOMO pull you in, just like so many others. To make this easy, I've divided the video into 3 clear parts for better understanding. First, we'll explore how Wall Street boardrooms discovered stuffing balance sheets with Bitcoin makes stocks soar. They pay $2 for every $1 worth of cryptocurrency on the books. It's mind-boggling. Think of it as spotting a $1 bill at a garage sale and eagerly paying $2 for it. In the casino of Wall Street, desperation often leads to such questionable bets, doesn't it? Now let's dive in together and uncover why this happens, step by step. It all began back in 2020 with MicroStrategy, an enterprise software company facing tough times. They had declining revenues, low market visibility, more disappointing than those lackluster Jurassic Park remakes. Then in August 2020, CEO Michael Saylor announced shifting cash reserves into Bitcoin. This move was as revolutionary as discovering garlic bread for the first time. Traditionally, companies park cash in safe, liquid assets like U.S. Treasuries for steady, risk-free interest. Cash reserves are like your family's emergency savings fund, meant to be secure and accessible. Putting them into something volatile like Bitcoin, which can swing 10% overnight, was unheard of. I know how risky that sounds. Imagine betting your home savings on a roller coaster stock. Things escalated toward the end of 2020 as Saylor ramped up the strategy. MicroStrategy issued convertible debt to raise capital, then used it to buy more Bitcoin. Convertible debt is borrowed money that can convert into company shares, a growth gamble. Fast forward to 2025, and MicroStrategy is fully committed to Bitcoin, an incredible transformation. They've morphed from a fading software firm into something like Kim Kardashian's career pivot. Now it's essentially a Bitcoin vault with a stock ticker symbol attached. They even dropped the micro, clears throat, and rebranded as Strategy to match the shift. Strategy holds about 640,000 Bitcoins, with an average purchase price of around $66,000 each. Their Bitcoin stash is valued at roughly $72 billion in today's market. Yet the company's market cap stands at approximately $85 billion. See the premium? Since 2020, the stock has surged over 2,200%, one of the top performers in 5 years. This success has spawned copycats everywhere, imitating the Bitcoin buying playbook. It doesn't matter if you're a Hong Kong gaming company or a Japanese budget hotel operator. Announce Bitcoin purchases and investors flock to buy your stock. Logic seems obsolete. We're all like NPCs in Michael Saylor's elaborate financial simulation, aren't we? Think of a small investor like your neighbor jumping in due to FOMO, only to regret later. Common misconception. Bitcoin is free money. Reality, it's a volatile asset with real risks. Comment number 1 if you think this FOMO madness is crazy. Number 0 if you see it as smart. Your thoughts matter. Let's discuss in the comments to build understanding together. Why does this happen? The answer is straightforward, yet eye-opening. Institutional capital, like pension funds and mutual funds, craves Bitcoin exposure. But their mandates, guidelines on allowed investments, forbid direct Bitcoin holdings. Mandates are like company rules banning candy, but you still crave the sweetness indirectly. So these funds buy Strategy stock for indirect Bitcoin access without breaking rules. Strategy offers a convenient workaround for managers to gain that desired exposure. Look at Strategy's shareholders. Vanguard, vocal Bitcoin critics, is the largest holder. This hypocrisy is hilarious, like pretending to hate junk food while secretly indulging. Imagine a fund manager stressing over mandates, losing sleep like you might over bills. That's why this is the worst trade in stock market history unfolding now. Managers pay a significant premium for this indirect Bitcoin exposure through Strategy. With $72 billion in Bitcoin, Wall Street values the company at $85 billion. They're desperate enough to pay about 18% extra just for convenience? This entire mess could end with a simple mandate change allowing direct Bitcoin. No more tricks, no premiums, no pretending to despise crypto while investing indirectly. It seems strategy has a foolproof get-rich-quick scheme, right? Step 1. Issue convertible debt to borrow funds at low rates. Step 2. Invest every borrowed dollar straight into Bitcoin purchases. Step 3. Profit from Bitcoin's rise and the stock's premium valuation. Wrong. There's hidden danger in this approach, my friend. The risk isn't margin calls, but the convertible debt's nature itself. At maturity, strategy must repay principal in cash or convert to shares if bondholders choose. Conversion leads to heavy dilution, slashing stock price dramatically. But the biggest threat is meeting interest and principal if Bitcoin plummets. If Bitcoin drops 50% like in past cycles, repayment becomes impossible. History rhymes, remember the dot-com bubble? Premiums built, then burst painfully. Or tulip mania, desperation inflated values, only for reality to crash in. Imagine a manager watching portfolios tank, feeling the same panic you might. Strategy isn't really a company anymore, just a glorified Bitcoin wallet. Institutional investors pay premium for assets inside this volatile vault. Ironically, those distrusting Bitcoin trust a rebranded software firm with billions in debt. Feel the burn of that premium hitting portfolios. It's relatable frustration. As your friendly finance guide, let's pause. In Wall Street's game, bubbles always pop. This desperation builds fragile structures, ready to collapse under pressure. What happens when the bubble bursts? Something to ponder together. I care about your financial journey. That's why we're unpacking this honestly. This truly is the worst trade ever, driven by shortcuts and hype. Subscribe to explore more Wall Street tricks and stay informed. What do you think of this trade? Comment your view below. Share if you've seen similar blunders in your investing experience. Your insights help us all learn and grow smarter together. Thanks for watching. Let's keep the conversation going. Until next time, invest wisely and question the hype.